Your notes have highlighted how you're very upbeat in the mainland markets. China A shares could be up 20%, you're saying, and re-rate as much as 40%. Are we ready for that kind of rally?
Yeah. The background for that note is the CSRC announced 9 measures to lay out the guidelines for the capital market development for the next decade. So we have 3 times the CSRC announced 9 measures in 2004, 2014, and 2024. This is the 3rd time. So if we look into the policies, we see 3 key policy focuses. One is to enhance the supervision. Second is to improve the quality of listed company. And the third is to enhance the investor protection. What we think is if China could catch up with global peers in terms of delivering higher shareholder returns through dividends or through buybacks, or if China could improve corporate governance level to catch up with global peers or even the leaders globally, and also the improving like the investor base, like bringing more long-term capital, that may help Chinese stocks to re-rating. Only from the valuation perspective, we estimate if China could catch up with the median level of the global peers, there could be 20% valuation upside, even without considering any growth impact. And if China could reach the level of top leaders globally, like the US or Europe, then China could have 40% valuation upside. That is the potential implication of the reform policies.
Okay, so that's interesting. So sweeteners like dividends, like buybacks, corporate governance, you think would be a draw for money into the markets, not as much, at least the first 20% earnings growth. But how are you mapping earnings growth? Because if you go by the Q1 numbers, things have not looked that bad. So yes, you may not get the earnings of the past peak, but you're still running at a decent rate. Do you not think that the market is undervaluing that trajectory, that momentum?
That's correct. If you look at the reported earnings number, actually it's pretty decent, especially last month we have the 2023 full year number. MSCI China stocks had 9% earnings growth year over year, which is still quite robust. And what leading the number is we see consumer-related sectors, including internet, consumer services sectors, are delivering around 30% earnings growth. So still quite strong consumption growth as we see. So looking forward, we think for the first quarter earnings, we have already seen some mixed signals. We do see some positive things like from Profit Alert announced so far. It points to a strong quarter, but at the same time, from a more macro level, industrial profit actually missed expectation. So we will still wait to see all the numbers coming through. But as investment implications, we still think investor needs to remain selective, especially overcapacity and deflationary pressure is still there. So we recommend investors to focus on companies which can continue grow their revenue and maintain their margin. So being selective is one of the direction. And also we believe non-tradable goods may perform better than tradable goods, i.e. services sector may perform better, while manufacturing sectors may be under more pressure.